Welcome to our deep dive. Today, we're going to be tackling investing.
Ooh, investing.
Yeah. Specifically, we're going to see if there's actually like a way to ensure you get your fair share of stock market returns.
Hmm. That's a really good question.
Yeah, right.
So to explore that, we'll be diving into a book called The Little Book of Common Sense Investing
Okay.
by John Bogle.
Oh, yeah, I've heard of him.
Yeah, he's the founder of Vanguard and like the creator of the first index mutual fund.
Wow. The first one.
Yeah, so he knows a thing or two about this.
Yeah, he seems like the perfect person to learn about this from.
Yeah.
So this deep dive is perfect if you want to understand investing, the fundamentals of it,
Yeah.
especially if you're intrigued by the idea of simplifying your approach and maybe maximizing your returns.
Yeah, and it's especially relevant if you're curious about whether investing is truly like a winner's game or
It's a winner's game.
if, as Bogle suggests, most of us are unknowingly playing a loser's game.
Uh-oh.
Yeah.
Loser's game. That's not good. Well, let's start by looking at like the concept of compounding returns.
Okay.
What's fascinating here is that it's not just about earning money. It's about earning money on the money you've already earned.
Exactly.
Yeah.
Yeah, that's the beauty of compounding.
The beauty.
Like it just keeps building and building and building.
Yeah.
Bogle gives a great illustration in the book.
Okay.
Imagine investing like $10,000 today
Yeah. $10,000. Got it.
at a 7% annual return, which is like a reasonable historical average for the stock market.
Okay.
In 30 years, you'd have over $76,000.
Wow.
That's the magic of compounding.
That's an incredible difference.
Yeah.
So you put in 10,000 and without doing anything else,
Yeah, you just let it sit there.
it turns into 76,000.
As long as you get that 7% return.
Yeah. It really highlights why staying invested for the long haul is so crucial.
Absolutely, yeah.
Yeah.
Time is your friend when it comes to investing.
Time is your friend. I like that.
But Bogle then throws us a bit of a curveball.
Curveball.
He suggests that most investors, even professional fund managers, often underperform the market.
Wait, really? You mean all that effort to like pick the right stocks and time the market can actually lead to worse results than simply staying invested?
Yeah, that's precisely what Bogle's research shows.
Wow.
He calls this the loser's game of investing.
The loser's game.
Actively trying to beat the market often backfires, especially after you factor in all the costs involved.
So instead of this loser's game of stock picking, what does Bogle propose?
Well, he suggests that we should shift our thinking and approach investing as if we're owning businesses.
Owning businesses. I don't know much about running a business.
Yeah, well, it's not about running a business. It's about owning a piece of a business.
Okay.
When you own a diversified portfolio of stocks, you essentially own a small piece of those companies you're sharing in their growth and success over the long term.
Okay, so if I own a little bit of Apple stock,
Yeah.
I own a tiny little piece of Apple.
Exactly, yeah.
That's a really interesting way to look at it. It makes investing feel much more tangible.
Right.
Okay, so then how do we win this game? How do we own these businesses and get out of this loser's game?
Yeah, this is where Bogle's solution comes in.
Okay.
Index funds.
Index funds.
Yeah. Have you heard of those before?
I have, but I don't really understand them.
Okay, yeah. So let's break down what an index fund actually is.
Okay.
It's essentially a basket of
The
stocks
basket.
that mirrors a specific market index, like the S&P 500.
Okay. The S&P 500.
So instead of trying to pick individual winning stocks, you're basically buying a piece of the entire market.
Oh, so it takes the guesswork out of it.
Exactly, yeah.
Okay. And what are the advantages of like investing in an index fund?
Bogle highlights several key benefits.
Okay.
Firstly, they tend to have low costs.
Low cost.
You're not paying high fees to fund managers who are actively picking stocks.
Okay, that makes sense. Lower costs mean more of my money is actually working for me.
Exactly.
Okay, what else is good about them?
Index funds also have minimal turnover.
Turnover.
This means they don't buy and sell stocks frequently,
Oh, okay.
which keeps trading costs down and can be more tax efficient for you.
Oh, so lower costs and like potential tax benefits.
Exactly.
Okay, any other advantages?
Yeah, they tend to be highly diversified.
Diversified.
Since they track a broad market index, you're automatically invested in a wide range of companies across different sectors of the economy.
Oh.
This helps to spread out risk.
So it's like taking the guesswork out of diversification. You're
Yeah.
automatically diversified by putting your money in this index fund.
Precisely.
Okay.
But perhaps the most compelling argument Bogle makes is about the tyranny of compounding costs.
Tyranny of compounding costs. That sounds scary.
Yeah, it can be. What does he mean by that?
He's referring to the impact of fees and expenses on your investment returns over time. Even small fees can compound and eat away at your gains.
Well, that sounds like a silent killer of investment return.
Exactly.
Yeah.
They just sneak up on you. And this is where index funds really shine.
Yeah.
Their low costs allow more of your money to compound over time, potentially leading to greater long-term returns.
Exactly.
Okay, this is really making me rethink my entire approach to investing.
Yeah, it's a real game changer.
So Bogle seems to be advocating for a long-term buy and hold approach with index funds at the core.
That's the essence of his message.
He believes that patience and discipline, combined with the power of compounding and the low costs of index funds, are the keys to successful investing.
Absolutely, that's the Bogle headway.
Okay. I'm definitely intrigued by this slow and steady approach to investing.
It's not as exciting as trying to pick the next hot stock,
Right.
but it could be a lot more effective in the long run.
But before we delve deeper into the potential downsides and risks of index funds,
Yeah.
let's take a quick pause.
Okay,
We'll be right back to continue our exploration.
sounds good. So we're back.
Yeah, we're back.
Let's continue our deep dive into index funds. You raised a great point before the break about potential downsides and risks.
Right, yeah.
It's important to consider those.
That's right. Index funds sound almost too good to be true.
Yeah.
What are some of the things we should be aware of?
Well, one thing to keep in mind is that by definition, an index fund will never outperform the market.
It's tracking.
So if there are some superstar companies out there that are growing at an incredible rate,
Right.
my index fund won't be able to fully capitalize on that growth.
That's true.
Mm.
Yeah, you'll capture the average return of the market,
Right.
but you won't be able to handpick those individual high flyers.
Okay, I see. So if someone is really confident in their ability to pick winning stocks,
Right.
index funds might not be the best fit for them.
That's a good point, yeah.
Okay.
Index funds are designed for investors who are comfortable with capturing the market's overall return
Okay.
rather than trying to beat the market.
Makes sense. What about market downturns?
Yeah.
How do index funds perform when the market takes a dip? That's another important consideration.
Okay.
Index funds are not immune to market fluctuations.
Right.
If the market as a whole experiences a significant decline,
Yeah.
your index fund will reflect that decline as well.
So they're not a magic bullet that can protect you from losses.
Right.
But I guess the idea is that over the long term,
Yeah.
the market tends to go up.
Right.
And your index fund will ride that upward trend.
Exactly. Yeah. Index funds are designed for investors who are in it for the long haul,
Okay.
who are willing to ride out the inevitable ups and downs of the market.
Mm-hmm.
Bogle emphasizes that patience and discipline are key.
Patience and discipline.
Right.
Got it. Okay. I'm starting to see the bigger picture here.
Yeah.
Index funds aren't about trying to time the market or pick individual winners.
Right.
They're about capturing the market's long-term growth potential
It gives that.
in a simple and efficient way.
That's a great summary.
Okay.
And remember, even within the realm of index funds,
Yeah.
diversification is still important.
Right. So even though an S&P 500 index fund is already diversified across 500 companies, it's still wise to diversify further.
Exactly.
Yeah.
Okay.
You could consider investing in index funds that track different market segments, like small cap stocks, international stocks, or bonds.
Okay.
This can further reduce your overall risk.
So don't put all your eggs in one basket,
Right.
even if that basket is already holding 500 different stocks.
Precisely. And remember, when it comes to choosing index funds,
Yeah.
cost is still king.
Cost is king.
Look for funds with low expense ratios
Okay.
to ensure that more of your money is working for you, not for the fund managers.
This has been incredibly helpful in understanding the nuances of index funds.
Yeah.
They're not a guaranteed path to riches,
Right.
but they do seem like a very compelling option for investors who value simplicity,
Mm-hmm.
low costs,
Yeah.
and long-term growth potential.
I agree. And it's worth noting that this approach isn't just for novice investors.
Oh, okay.
Many experienced investors, including some very successful ones,
Have embraced index funds as a core part of their portfolios.
You mentioned earlier that even some of the biggest names in investing have endorsed this approach.
Right.
Can you remind us who those folks are?
Of course. So Bogle's book includes endorsements from Charles T. Munger,
Okay.
Warren Buffett's longtime business partner,
Wow.
and William Bernstein,
Okay.
a renowned financial author and neurologist.
A neurologist.
Yeah. So both are highly respected figures in the investment world
Wow. Okay.
and strong advocates for index fund investing.
That's quite a vote of confidence.
Yeah.
So if these brilliant minds believe in the power of index funds, it definitely makes me want to explore this approach further.
And that's exactly what Bogle hoped to achieve with his book,
Yeah.
to empower investors with the knowledge and tools to take control of their financial futures.
I'm feeling much more empowered already.
Good.
But before we wrap up,
Yeah?
I'm curious about something. If index funds are such a powerful tool, why aren't they more widely adopted?
That's a great question.
Is it just a lack of awareness, or is there something else going on?
That's the million-dollar question.
Yeah.
Perhaps it's the allure of trying to beat the market,
Mm-hmm.
the excitement of picking individual stocks, or maybe it's a lack of trust in the simplicity of the index fund approach.
It does seem counterintuitive to some people that simply buying the market through an index fund could be a path to financial success.
It challenges the conventional wisdom
Yeah.
that you need to be actively picking winners and losers to outperform.
Yeah.
Bogle's approach is more about embracing the market's overall growth potential
Okay.
and letting time work in your favor.
This deep dive has definitely given me a lot to think about.
Yeah.
It's made me realize that investing doesn't have to be stressful or complicated.
Right.
There's a lot to be said for simplicity, patience, and the power of compounding.
I agree. And while index funds might not be the right fit for everyone,
Right.
they offer a compelling option for investors who value those principles.
So as we wrap up, what key takeaways would you leave our listeners with today?
Okay, first, remember the incredible power of compounding returns.
Compounding returns.
Time is your greatest ally in investing.
Okay, number one, compounding returns.
Number two, be mindful of the costs associated with investing.
Costs. Okay,
Even small fees can significantly erode your returns over time.
got it.
And third, consider the benefits of simplicity and diversification.
Simplicity and diversification.
Index funds offer a straightforward way to achieve both.
This deep dive has been a fantastic exploration of John Bogle's investment philosophy.
It really has.
It's challenged our assumptions, expanded our knowledge, and given us a fresh perspective on the world of investing.
And if you're intrigued to learn more,
Yeah.
I highly recommend picking up a copy of The Little Book of Common Sense Investing.
The Little Book of Common Sense Investing by John Bogle.
It's packed with insights and wisdom that could potentially transform your approach to investing.
Until next time, happy investing.
Happy investing.
We're back, ready to wrap up our deep dive into index funds.
Yeah, it's been quite a journey exploring John Bogle's investment philosophy.
It really has, one of the things that really struck me was Bogle's emphasis on simplicity.
Mhm.
He seems to be saying that investing doesn't have to be complicated or intimidating.
Absolutely.
Yeah.
Bogle's approach is all about democratizing investing, making it accessible to everyone, regardless of their financial background or expertise.
Yeah, that's really empowering.
Yeah,
He's essentially saying you don't need to be a Wall Street whiz to build a solid investment portfolio.
exactly. You don't need to spend hours poring over stock charts or trying to outsmart the market.
Right.
In fact, Bogle argues that trying to beat the market is often a losing game.
Yeah, instead, he suggests that we focus on owning a piece of the market through index funds
Right.
and let the power of compounding work its magic over the long term.
Yeah, and remember those endorsements we talked about from Charles T. Munger and William Bernstein?
Oh, yeah, right.
Both highly respected figures in the investment world,
Yeah.
advocating for the simplicity and effectiveness of index funds.
It's amazing to think that this seemingly simple approach has garnered so much support from some of the brightest minds in finance.
Yeah, it speaks to the power of Bogle's ideas and the potential of index funds to, like, revolutionize the way we think about investing.
But if index funds are so great, why aren't they more widely adopted?
That's a great question.
Yeah, is it simply a matter of education, or are there other factors at play?
Yeah, that's the million-dollar question, right? Perhaps it's the allure of trying to beat the market,
Mm-hmm.
the excitement of picking individual stocks, or maybe it's a lack of trust in the simplicity of the index fund approach.
It does seem counterintuitive to some people that simply buying the market through an index fund could be a path to financial success.
Yeah, it challenges the conventional wisdom that you need to be actively picking winners and losers to outperform.
Right.
Bogle's approach is more about embracing the market's overall growth potential and letting time work in your favor.
This deep dive has definitely given me a lot to think about. It's made me realize that investing doesn't have to be stressful or complicated.
Right.
There's a lot to be said for simplicity, patience, and the power of compounding.
I agree. And while index funds might not be the right fit for everyone,
Yeah.
they offer a compelling option for investors who value those principles.
So as we wrap up, what key takeaways would you leave our listeners with today?
All right, so first remember the incredible power of compounding returns.
Compounding returns.
Time is your greatest ally in investing.
Got it.
Second, be mindful of the costs associated with investing. Even small fees can significantly erode your returns over time.
Okay.
And third, consider the benefits of simplicity and diversification.
Simplicity and diversification.
Index funds offer a straightforward way to achieve both.
Well, this has been an absolutely fantastic deep dive.
Yeah, it's been fun.
It's really challenged some of my assumptions about investing, and I feel like I've learned a lot.
Good. I'm glad to hear that.
Yeah. So until next time, happy investing.
Happy investing.